Come back to our project, and in the last video we actually calculated our covariance and correlation, that is how closely related are our two assets. So when one goes up, the other one will go a little bit down since they are negatively correlated, which is pretty positive, pretty optimistic, because when one asset fails, we are we have some stability for our second asset to go stable in the market. So today we're going to actually start diversifying our portfolio. So we'll start with 100% stock and 10% bond, and now we'll reduce 10% each. So I will type this formula, which is equal sign the previous percentage minus by 10%, so you'll be 90%. If I drag this down, you will go gradually, and you will go eventually to 0. This formula is pretty helpful, pretty efficient. And if I want to now increase, sorry, it should be 0%. I made a mistake here, sorry guys. And 0% here, I want to also go by 10% up each time, so I just have to click this and add up by 10%, and then I just have to drag this down, so you'll be 100% last. And now let's calculate the mean after we diversify them, which is $. We take the percentage, and now we times them by our mean return plus our mean plus the percentages for our bond and times our mean return. Now be careful. First of all, we have to bracket them up, and be careful, we have to $ this B3 and B3 and B4, because $ means relative cell reference, which means no matter wherever we go or sell, we're always referenced based on B3 and B4, so we will not get confused. So the Google Sheet will actually give us correct data. So in this case, we can actually make sure we get the correct data. So now calculate our mean. Wait a while, there's some certain mistake right here. I don't know what mistake is it, but it's supposed. Oh yeah, I didn't do the average. Sorry, to the average. Yeah, so this is for a formula. Remember to $ it. So after we drag it down, you always reference to this. So it is pretty important to do that. And this is our average. Our average. Wait, why is it showing 100%? So wait a while. So you times this plus this. So this is a way to go. So sorry for that. Oh man. Yeah, that seems to take a little bit more time in euro. Yeah, so 1.09 is what we got. But now, so sorry for just now the mistake. So just see the formula again. And now if we drag it down, it'll be something like this. Okay, so now we got our mean. So this is our mean return after we diversify our portfolio. So it's basically relative to how much what percentage of portfolio we want to invest in each asset. And now we want to calculate the variance. Please look carefully, it can be a little bit complicated. So first of all, we take our percentage for our stock, then we power them by 2, square them by 2, and then we times the variance, which is our risk. We are using this case since variance correlates to variance, standard deviation is standard deviation. And after that, what we do is we are now finished with this, and now we do the same for the bond. We take the percentage, power them by 2, remember the power symbol right here, and then we time this variance for that. And now we still have a last step, that is to plus 2 times the covariance. So now we need the covariance right here. Sorry, is this cell here? And now we're actually officially completed. We have completed this. So, oh sorry, I didn't bracket it. So remember to bracket, otherwise Google Sheet will not be happy. Yeah, so pretty much we got this, and now I have to $ this, $ C3, because we now have to $ C3 because C3 is actually our variance that is fixed. So remember I talked about relative cell referencing that keeps the data the same place, so we have to reference this, and definitely we have to also $B and 6, so we actually always reference to this. So now if we drag it down, we'll get data that we want. So we have our variance here. For standard deviation, you can definitely do it independently, the same method, but then you just take the data from the standard deviation here. But we don't have to do that since we have our variance. So what we do is pretty easy, equal sign SQRT, which gives us a square root option, and we just fill in the cell here, and we don't have to $ it since we have a different data. So what we do is just easy, we just space it out. So I want to use the percentage, so it's fine. So you can see there's the highest risk involved when we invest 100% stock, but the lowest risk doesn't happen when we invest 100% bond, but it happens to be somewhere here when we invest in 60/40. Now is the important point. and we'll keep it in the next video. We'll calculate our Sharpe ratio. So hi guys, so in this video we discussed about our diversification. We actually calculate variance, standard deviation, and mean. And in the next video we'll actually start graphing our model after we finish calculating the Sharpe ratio. So thank you guys, and I'll see you in the next video.